Welcome to The Explainer. Today we're digging into a really fascinating specialty chemical company, Archean Chemical Industries. So the big question is this: is this a world-class business with an unbeatable competitive advantage, or is it a company that's just plain stuck in a muddle? Let's find out. But before we get into the weeds, let me ask you something. What if you could own a piece of a business where the main ingredient is totally free, and it's a natural resource that nobody else can get their hands on? That idea right there is the entire investment case for Archean. Here's how we're going to break it down. We'll look at their incredible advantage. Then we'll figure out why their finances have struggled. After that, we'll check out their growth plan, weigh the risks, and finally, we'll get to the final verdict. Okay, so let's get right into it. What gives ACI its edge? Well, it boils down to what investors love to call a moat, a powerful competitive advantage. And Archean's moat? Well, it's literally built on salt. So what do these guys actually do? They're India's only big player in what are called marine chemicals. Basically, they pull super concentrated seawater, or brine, right out of the ground and turn it into really valuable stuff like bromine, industrial salt, and something called sulfate of potash. And just to give you an idea of the scale we're talking about, ACI controls 240 square kilometers of these brine reserves in Gujarat's Rann of Kutch. I mean, this isn't just a factory we're talking about. It's a massive, one-of-a-kind geographical asset that no competitor can ever hope to copy. And you know what? That incredible geographical advantage, it translates directly into a killer business model. Think about it. Their main raw material, that seawater brine, is completely free. That makes ACI the lowest cost producer of bromine on the entire planet. It's why they can export almost 80% of what they make and build this whole integrated system from the raw brine all the way to advanced chemicals.
Okay, so that all sounds amazing, right? Which brings us to the central puzzle here. If the business has such an unbeatable moat, why have the financials looked so weak recently? Let's dig into the numbers and see what's really going on.
And wow, when you look at the numbers, the problem is crystal clear. After hitting this supercycle peak profit of 384 crores in FY23, profits just cratered. They fell by more than 50% to just 185 crores by FY25. That is a massive, massive drop. And the contrast between those 2 years, the peak and the trough, is just staggering. Look at return on capital employed, or ROCE. It fell from a fantastic 46% all the way down to 16%. But the real red flag for me, look at debtor days. It doubled from 30 to 62. What that means is it's taking them more than twice as long to get paid by their customers. And you can see how that just crushes their free cash flow, from over 400 crores down to just 79. You know, this timeline really shows what a roller coaster this company has been on. Just a few years ago, in FY18, they were drowning in debt. Then, bam, the 2022 IPO completely turns things around. They had that super cycle peak with what looked like an untouchable balance sheet. But now that fortress is being seriously tested by this downturn and their own internal problems. So the big question is, how does management plan to dig its way out of this mess and get back to growing? Well, they've laid out a pretty clear 4-part strategy. Let's break it down. Okay, so the plan has 4 key parts. First up, they need to fix their core business, get that bromine production back up to where it should be. Second, they have got to finally launch their long-awaited sulfate of potash fertilizer. Third, they need to ramp up their new derivatives plant. And fourth, they're making some pretty ambitious long-term bets on things like semiconductors and batteries. Of course, a plan is just a piece of paper until you actually execute it, right? And the analysis we're looking at flags some pretty significant risks that could totally derail this comeback story. And this is where we get to a really crucial point: management's credibility. That key sulfate of potash project, it has been hit with delay after delay. For multiple quarters, the company has just repeated the same excuse: plant-scale trials pending. This track record of missing their own deadlines, it's a huge concern. This table does a great job of summarizing the key risks. The first big red flag is that weakening earnings quality, which we saw in those debtor days doubling. The second is execution risk. I mean, are they trying to do way too much at once with 4 or 5 brand new projects? And when you add in a history of missing their own targets and this huge loan to a totally unproven semiconductor side business, well, you've got some serious things to keep an eye on. All right, so there you have it, the world-class moat on one side and the operational muddle on the other. Let's see how the analysis weighs all of this to come to a final verdict. So the analysis lays out 3 possible futures for the company. There's a bear case where the problems continue and the stock could drop by about 51%. Then there's the bull case where everything goes right and you could see a 41% upside. And then there's the base case, which assumes things get better slowly, and in that scenario, the stock is basically fairly priced right where it is today. So after running it through a detailed scorecard, looking at everything from the quality of the moat to the execution risk, the analysis gives Archean Chemical a final score of 71.7 out of 100. That puts it squarely in that good but not quite great category. And so, the final verdict from the analysis is to accumulate. The big takeaway here is that the long-term powerful strength of that incredible natural moat is just compelling enough to outweigh the short-term and, hopefully, fixable operational problems. And that really leaves us, and you as a potential investor, with the million-dollar question, do you believe the power of this irreplaceable moat is strong enough to make up for the very real execution risks that management has shown? Okay, before we wrap up, I need to share a quick but really important disclaimer. The analysis in this explainer is purely for educational and informational purposes. I am not a SEBI-registered research analyst or investment advisor, so please, this is not a buy or sell recommendation.
Investing in the stock market has significant risks, and all the data you've seen is based on public information. So please always do your own homework, your own due diligence, or better yet, talk to a SEBI-registered professional before making any financial decisions.
If you found this deep dive helpful and you want to see more stress-free investing analysis, do me a favor and hit that subscribe button and ring the bell icon. That way, you'll never miss an update. And now, I want to hear from you. Which Indian-listed company should I break down next? Drop the stock name in the comments below, and who knows, it might be the star of our next explainer. Thanks so much for watching, and keep your investing stress-free.